Amit, are we recording this?
Streaming live on Zoom, YouTube,
Okay.
LinkedIn, and X.
Amit, let me know if we can start the
Yes, we can
session.
start. We can start.
Okay. Good evening, friends. A warm welcome to all for this session. Today, we are covering a very unique or a different kind of a session rather than talking about products or talking about the offerings. The most important thing that we are trying to cover in today's session is a five-letter word which is called as trust. Okay. Now, when we talk about individuals dealing with each other, the first factor that comes into picture is trust. An investor dealing with asset management or between companies, the factor that comes in is trust. And when we convert it for companies, the word that we use is corporate governance or quality of management, which is a term which is synonym to trust. Now, the similarity between both these factors is one, and that is subjectivity. Now, for a person who's dealing with Mr. ABC, the Mr. X might feel that Mr. ABC is a genuine person. At the same time, Mr. Y, who's dealing with Mr. ABC, might feel that it's not a kind of a person that he would like to deal with. Similar is the case when it comes with companies. Two fund managers talking about the same companies can have a view where one person feels that this corporate continues to have a genuine management, whereas the other person continues to feel that there is some kind of a shadiness that agrees or comes with this particular management. Now, how do we put this to rest? Okay, because this is something which will keep on happening on this subjective world. And that is what we have been able to do over here. Let me take this opportunity to introduce Sachin Shah. Sachin Shah is a veteran fund manager in the industry, having close to 2.5 decades of experience today. In fact, more than 2.5 decades as we speak today. Spent his first decade with Motilal Oswal Asset Management and the broking business, and currently he's been with MK for last 13 years now. To a large extent, he's been the pioneer behind the PMS launches, where we have been able to create a track record of more than 12 years in our PMS scheme. What we would hear from Sachin is how he has been able to cultivate this subjectivity which exists when dealing with corporates and bring it to the framework of having some numerical terms through which we are able to uh, understand whether to go ahead with this corporate or not, or to invest with this company or not. Let me also share that with this model, we have been able to avoid accidents till now. I won't go more in detail. I would now invite Sachin to talk about this particular model, the E-QUAL model, which he has been working with for last 11 years. Over to you, Sachin. Sachin, you are on mute.
Thank you, Nagesh. Thank you so much for setting the context. Good evening, everyone. It's indeed a privilege and a pleasure to be here with all of you. Nagesh has already set the context, but just to give you some more background about this E-QUAL model. This is a proprietary module. E-QUAL basically it stands for MK quantitative risk. But about nearly 12 years back, actually 14 years back, I and my colleague were actually discussing about all our decisions that we had made in the previous 5 years. And while we were looking at some of our decisions and we were evaluating, we quickly realized that a lot of challenges in terms of our decisions were actually non-related to P&L and balance sheet, right? So it was more to do with the qualitative factors, more to do with the management qualitative factors, and the other very important part was also in terms of although we selected the right companies or the right businesses, it was also a function of the wrong purchase price. So, we said that, all the mistakes or whatever challenges that we faced in the past, at least we should ensure that we don't do them, in the future. So we tried to create this module, keeping that background. And that's how the E-QUAL model actually got, established. So what we also quickly realized while we were discussing all of this is that, companies which are large, right, they definitely tend to have lower volatility in terms of their stock price compared to a mid and a small. And within the large also, companies which are better quality also tend to have lesser volatility compared to a, large company with but a much lower management quality, right? So, that's how this entire framework got into play. And then we said that, can we create a module so that, we can jot down all the important parameters and then give some scoring, which will help us in deciding what is a good quality. Because quality, as Nagesh just mentioned, is a fairly subjective thing. But can we convert this subjectivity into an objective exercise? Can we convert this subjectivity into an objective exercise by publicly available data points? So there's an apple to apple comparison across companies, and there is no bias or there is no prejudice with the past, apprehensions or past perceptions that we have towards the company or the management. So what we would do is that in the next few minutes, we will share a presentation with all of you, which will help you, understand the entire nitty-gritties and nuances of the model that it has gone through, and which allows us to get a very decent score. And I can assure you, like Nagesh again mentioned, that thanks to this model over the last 12, 13 years at MK, under our PMS, particularly in our flagship strategy, which is MK Capital Builder, MK Pearls, also in all our AIFs, MK Emerging Stars Fund Series 1, 2, 3, 4, and 5. We've not had any blow ups till date over the last 14 years. And I'm sure all of you understand that over the last 12, 14 years, there have been at least 150, 200 companies where there has been significant amount of blow ups as far as corporate governance is concerned. And minority shareholders have lost significant amount of wealth. So thanks to this model, we've holded ourselves very well over the thick and, over the entire journey. So we'll just start with the presentation. Just give me 30 seconds and I think we should be able to load that. Yeah, so as I was mentioning earlier, that one of the very important aspects is also to understand the size of the companies. So we said one of the very thing is that we should look at is the sorting of companies on size, because within the large cap, mid cap, small cap, we have seen that the volatility is higher, and if the volatility is higher, clearly your return expectations also have to be a little different. The other very important part has been that we want to capture all the data points which generally we are not able to capture through a P&L, balance sheet, or a cash flow. And the idea is that we want to focus on the management quality, which focuses on management integrity, management capability, distribution to shareholders wealth, investor communication, and liquidity.
Sachin, I think the slide has got hung. If you can just move.
Okay. Are we on the risk adjusted returns now?
Sir, I
Sorry,
think you'll have to press F5. So the PPT goes into full screen mode. And then when you play it, it will be able to play it as the slides that you're moving.
Okay.
If you press F5 on the keyboard, it will make this presentation a full screen view.
Just give me 30 seconds. Okay, so I think we'll move on. on the risk adjusted returns, as I said, that we also want to capture management integrity, capability, distribution of shareholders wealth, investor communication, and liquidity. As I mentioned earlier, one very important aspect of this model is that it is based on all the publicly available data points. So it's very easy to have an apple-to-apple comparison across companies. Along with that, what we also realized over a period of time, that there are certain points where we have to avoid businesses at any cost, because those are truly red flags, and we will discuss more on that as we move forward. So now this is the slide where we talk about the sorting of the companies, right? So, SEBI came up with regulations about large cap, mid cap, small cap in 2018, sometime early 2018. This model was created at least 7 years before that. And at that point in time, we had very clearly decided what is a large cap, what is a mid cap, what is a small cap. And fortunately for us, the SEBI guidelines are also on very similar lines, where it is on relative market cap ranking. And we had said that the top 125 companies will be in large cap, and we of course subdivided the large cap also into large cap 1 and 2. As all of you know today, that as per the SEBI guidelines also, the top 100 companies are large cap categories. So we are very much on those lines. The reason why we subdivided large cap into large cap 1 and large cap 2 is because when we had created this model, we said that the top 50 nifty companies should be the large cap 1 category. But at least 12 years back, the large cap 1, the 70th company's market cap was very similar to the 50th company. So we kept large cap 1 as the top 70 companies. The next 70 to 125 companies were the large cap 2. The mid cap is 125 to 250 companies. The SEBI guidelines even today at this point in time is very similar. From 101 to 250 is a mid cap company. And that is how we decided the mid cap also. And then, generally we would like to have our investment universe in the top 600 companies. So which is where the small cap 1 and small cap 2 got created in our scheme of things. The other very 5 core parameters that we wanted to focus on was in terms of the management integrity, in terms of management capability, wealth distribution to minority shareholders, liquidity, and investor communication. These were the 5 key parameters that we want to really focus on. And that is where the entire module has been created around. Right. So, when we talk about the management integrity, right? So these are some of the parameters that we actually jotted down, right? We look at the promoter holding. The thought process again here is that, investing is a game of probability, right? And we have to reduce our probability of going wrong. The lower the probability of we going wrong, higher the probability of we winning our game, right? So the idea here is that higher the promoter holding, higher the skin in the game, we will have, there is a much lower probability of the promoters doing something silly, particularly in the mid and small cap, right? So the weight that we've assigned here is 7.5%, right? But within this, again, there are 5 sub parameters. For example, say today the SEBI allows maximum promoter holding at 75% in a publicly limited company, right? So, wherever the promoter holding is 70% or more, we will give them full 7.5% weight for this particular company. Wherever the promoter holding is 30% or less, they will get 0 percentage of weight for this particular parameter. Wherever the promoter holding is between 30% to 50%, we will give them 2.5%. Wherever the promoter holding is between 5 to 7.5%, we give them 5% weight, right? Once the promoter holding, the next we'll be looking at promoter holding has been increasing or decreasing over the last 2 to 3 years. If the promoter holding has been increasing, we give them 2.5%. If the promoter holding has been decreasing, we give them negative marks. The other very interesting parameter for us is also the equity dilutions. If there are too many equity dilutions, we don't like that business model, because either the business model is weak to not sustain a long-term growth, or there is some hanky-panky going on by the promoters acting out of the funds or something like that. So lower the equity dilution, higher the marks are given to this particular parameter for the companies. Promoter holding pledge. This is again a very interesting parameter that we would like to focus upon, right? So we have seen from the Satyam days to many companies, even in the recent times, wherever the promoter holding pledge is disproportionately higher, there has been a compromise to minority shareholders' interest, right? So this is something, again, a very important parameter that we are focused about. Promoter group salary. We have also seen here some companies where promoters take disproportionately higher salaries as a percentage of their profits, and we believe that this is clearly again a compromise with the minority shareholders' interest. Auditors, again a very important parameter that we focus on. Are they among the big four? Are they known or are they unknown auditors? Right? If they are among the big four, we'll give them full 5% weight. If they are among the known auditors, we'll give them 2.5, and if they are unknown auditors, we'll give them 0 weight. We also look at inter-party related transactions, right? If there are very high percentage of inter-party related transactions as a percentage of turnover, then obviously it's a red flag for us. In case of multinational companies, we have seen in the past many times where royalty is a very large portion of as a percentage of the profits. Again, here we are quite focused about looking at the minority shareholders' interest, and unless it's a very reasonable number, it's a red flag for us, right? The other very important aspect is also in terms of the management capability, right? Now, when we talk about the management capability, we have to be focused about every business goes through a good and a bad cycle. Yeah, I think just 1 second, we'll share the screen in 30 seconds. So when we talk about the management capability, I think every business goes through a good and a bad cycle. And how is the management maneuvered during the bad cycle is actually reflected in the balance sheet of the companies, because P&L is just for 1 year, cash flow is also just talking about the 1 year, those kind of things. But balance sheet is actually a cumulative of last so many years. And at that point in time, what kind of capital allocation was done, what kind of discipline the management got into their working capital, what kind of discipline the management got into in terms of their capital cost efficiency, track record of project executions, is all reflected over there. So that these are some of the parameters that we are focused about when it comes to debt equity. Within debt equity, what is a long-term debt, what is the working capital, and also, if suppose there was some bad times and the company had to go through a debt restructuring, is it been only once, or has been or the company has went into a debt restructuring more than once in the lifetime of its overall period? So those kind of parameters also really help us in understand the management capability over the last so many years. Capital cost efficiency is also a very, very interesting parameter that we focus about, because whenever the large capexes are announced, what kind of efficiency the management got in? Is the capex on a per unit basis in line with the industry benchmark? Is it significantly higher, or is it better? Are they much more efficient? Because finally, the ROCE, the return on capital employed, is going to be a function of your capital cost. Track record on project execution, because we've seen many times the projects are announced, but there is a humongous amount of time and cost overruns. So these are some of the very important parameters that also help us in understand the capability of the management. The other very important aspect is the wealth distribution to the minority shareholders. So dividend payout clearly directs us to say the kind of the business model that the company is into. Because if you are a very strong business model where you don't need very large capexes for your future growth, the dividend payouts can be very, very large, as high as 70, 80, 90, 100%, as we have seen in some of the large multinational FMCG companies. That speaks of a very, very strong business model. That also speaks, of the cash flows that the company is able to generate, and not just the profits. Because, cash flows are very difficult to manipulate. Companies can manipulate P&L, companies can do some window dressing with their balance sheets. But cash flows is very, very difficult. I mean, there could be a few exceptions, but those will be truly outliers. But largely speaking, cash flows are very difficult to manipulate, and dividend payout is a very important parameter which reflects on the cash flows also. The other very important parameter we've seen where destruction of minority shareholders' wealth has happened is in terms of large acquisitions. Whenever a large acquisition has been done by a company, 7 out of 10 times, 8 out of 10 times, it hasn't played out the way the company had anticipated, at least for the first 2, 3, 4, 5 years. And that definitely has destructed minority shareholders' wealth over a period of time. So, whenever, and what is a large acquisition? If it is more than 50% of your current balance sheet size, we would like to classify it as a large acquisition. And whenever that happens, we become fairly conscious, and we would like to avoid investing in those businesses, at least in the initial years. After the first 1 or 2 years, we would like to reevaluate, and if the acquisition is playing out the way it is anticipating, if it is adding value, if it is EPS accretive to the existing business, we are very happy investing in those businesses. Investor communication. Again, our job is to do research, and unless we get enough investor communication, the regular updates, whether it is annual reports, whether it is quarterly conference calls, whether it is presentations, all of those information, the more transparent the company is, the more better it is for us to understand the business, the more important, critical it is for us to understand the nuances of the business, and then it's easy for us to make our investments. Liquidity is always an important parameter because we are into public markets, and liquidity also plays an important role in terms of the stock price volatility. These are some of the red flags that we are extremely averse about. So as I was mentioning about promoter holding pledge itself is a something that we are very averse to. But if the promoter holding pledge crosses above 70% of the promoters actual holding, we would definitely like to avoid investing in those businesses. Wherever promoter salaries is more than 50% of the PAT, again, we don't like to invest in those companies. Debt restructuring done more than once, we would like to avoid. Wherever there's a debt equity of more than 2.5 times, we avoid investing in those companies. Large acquisition we just discussed, which is more than 50% of the balance sheet size, we would not invest. We have also seen many times managements actually get into a lot of unrelated businesses, and that is when again we have seen that we have had some challenges. So whenever a company is investing more than 50% of their balance sheet size into an unrelated businesses, we would be on a wait and watch rather than jumping into it. And if there is no investor communication, we have seen there are many companies, particularly multinational companies, which are great business models, which generate a lot of cash flows, but there is absolutely no investor communication. Even in their annual report, they don't discuss what has happened in the business, what are the nuances of their business, what is the future outlook. We would like to avoid investing in those businesses because as long-term investors and as very, I would say, research-based investors, we would like to have full information on the businesses. I was also mentioning earlier in terms of the purchase price, right? After evaluating companies on quality, we would also like to understand the purchase price. But as you can see, this risk-reward matrix here, it might look a little complicated, but just to simplify it, wherever the score based on the E-QUAL model that we discussed so far, if it is below 50%, it comes into our do not invest radar. So unless the company has a score above 50%, it is out of our investment universe. Now, within the above 50%, we have categorized the companies into three parts. One is 85% plus, second is 70 to 85%, and third is 50 to 70%. So these are the first three categories that we have divided companies on their scoring. In the very first early slides, we also spoke about the companies on their sizes, which is large cap 1, large cap 2, mid cap, small cap 1, and small cap 2. Right. So this is where basically we are we break down the companies into the matrix. Wherever company which is a large cap 1 and has a 85% plus, it's like a triple A scoring for us. Wherever the company is a large cap 2 category, which means the company is between the ranking of 70 to 125, but has a score of 85 plus, will be a double A kind of a thing. Wherever the companies have a score between 70 to 85, we would call it like a base case. These are like average companies. Companies with 85% plus will be above average. Companies between 50 and 70 are called as below average, right? So this is how the matrix comes out to be. Whenever we evaluate a company, we run through this E-QUAL filter, and once we know the score, and of course we know the market cap, we understand the size of the company, we would put that company in this matrix, which tells us that what is the kind of the risk we are playing. For example, if there's a company, say in Infosys, obviously it will have a score of 85% plus. It is a large cap 1. So it comes in the large cap base 1 kind of a that which is in the very topmost left column, or the topmost left square is where Infosys sits. And if there is a mid cap company with a score of between say 70 to 85, a score of say 75, 77, it comes 2 notches below that. So once we know this differentiation, it helps us understand the kind of the risk that we are taking, the kind of the volatility that we are adding to our portfolio. And that also helps us understand the purchase price. So for example, if you look at say a base case, my return expectation should be say just about say 15% return, right? Clearly, or say my base case could be anywhere say 20% return, right? So for a company which is say 85% plus, my return expectation will be sub 20%, which is at 15% kind of thing. And for a company which has a score of subpar of between say 50 to 75%, my return expectation will definitely be more than 20%, so say about 25%, right? So as we go down and as we go more right, the return expectations from each company will be higher, and as the return expectations are higher, my purchase price for each of these companies will be lower. So this is how this risk-adjusted matrix also allows us not only to decide the quality of the company, but it also allows us to decide the good purchase price, because that's how this entire model is embedded into. Just to share with you that thanks to this model, over the last 11 years, our flagship product MK Capital Builder, which is a flexi cap, large cap biased kind of a product, nearly 60 to 70%. We have large caps in this portfolio. We've delivered nearly 17% compounded returns over the last 11 years, which is 5.5 times the money that was invested over this 11 years. Even over the last 1 to 3 years, as you can see, that we've delivered very decent returns, and it is all thanks to this model, which has helped us, basically delivered very superior risk-adjusted returns. The kind of the risk that we've taken for these portfolios is significantly lower. The beta of our portfolio over the entire 11 years has been in the range of 0.7 to 0.8. Which is significantly below, whereas the returns that we've generated are at least 10 to 15% higher over the benchmarks. These are some of the companies that we own even at this point in time, and this is how the game of compounding has played out for us over the last 10 years. As you can see, nearly 40% of the portfolio now has 10 years plus vintage. Significant amount of compounding has come in from these stocks. Nearly 80% of the stock portfolio at this point in time now is now already 5 to 10 years of vintage. In the last 2-3 years also, we've added quite a few good stocks. Companies like Zomato, Axis Bank, all of them have been a part of our portfolio. I was mentioning earlier in terms of our MK Emerging Stars Fund, Series 1, 2, 3, and 4. Series 1, 2, and 3 we launched in January 2018. And over the period, we've delivered very decent 15% compounded returns. We returned nearly 500 crores back to the investors before time. Even our NK Emerging Stars Fund Series 4 delivered 20% plus XIRR returns. And even over here, we returned money to investors before time. Thank you so much for your patient hearing. We will now be open for Q&A. Over to you, Nagesh.
Yeah. Participants, if you have any question, you can type it in the Q&A session. We'll be more than happy to answer those questions. So, Sachin, there is one question which has come that, it says, does this model also work when we are doing offshore investments or not? So, how do you want to answer that particular question?
Yeah, that's a very interesting question. Frankly, to be very honest, we haven't implemented this on the global companies. But I think it's a good point, and I am particularly very curious that we would like to implement this model on some of the global companies. It's just that over the last 15 years at MK Investment Managers, we are only focused on one asset class, which is listed Indian equities. That is where we specialize. In fact, I, as an individual, also over the last 25 years, have only done one thing, and which is listed Indian equities. So this model, I can promise you, has worked brilliantly for us as far as the listed Indian equities is concerned. And at an organization level, we all swear by this model, and we are very, very disciplined about implementing this model. And for each and every investment that we do, we filter all our investments through this model before even we thinking of doing more detailed research. So it has worked brilliantly. So my sense is it should work even with the global companies, because the basic principles of investing are very universal. But we haven't had any practical experience, to be honest with you. But we will work on this, and hopefully next time we will have an answer to this too.
Okay. Sachin, one more question which has come up is, how does E-QUAL model work in case of professionally run businesses? Okay. For examples, like L&T or ICICI, where there is no promoter holding as such. Now, how do you evaluate the quality of management using this E-QUAL model? Because when it comes to promoter or any other stuff, we have something, but how do we evaluate it over here?
Yeah, that's a very good point, Nagesh. So the way we look at it is that wherever there are professional management companies, for promoter shareholding, we will give them full marks, right? Because you don't expect a promoter shareholding in a HDFC or ICICI bank. These are very strong governance kind of boards. So we give them full marks for those parameters. But say, for example, an auditor, right? So they are at par with other companies over there. They need to appoint some good auditors among the big four, or at least the known auditors. So there the scoring will be there. Or say, for example, promoter group salary. So what is the top management salary as a percentage of the profits, right? That's also a very important parameter that we would look at. Or say equity history dilution, right? We have seen that, just to give you a classic example in my experience itself, in the at least 15 years back, or at least say, if not 15, 12 to 14 years back, ICICI Bank used to have in fact, in those days, it was not even a bank, it used to be ICICI Limited. It used to have very regular equity dilutions, whereas HDFC as a group was having very limited dilutions. So, those kind of parameters remain, similar for all of them, and that's how the scoring happens. So except for one or two parameters like the promoter shareholding, we don't have to tinker the model much. So only for promoter shareholding, we give them the we give them the benefit and we give them the full marks.
Okay. Very interesting question which has come up, Sachin, right now, saying that, uh, this is now, I don't know who's asked this because it come as an anonymous attendee, but the question states that the top four auditors have actually not been true to what they have been. I mean, in true sense, for last few years, there have been some iota of doubt, which is as per the question over here. So why then this condition of having top four auditors is one of the parameters in the equal model that we have formulated?
Sure, that's also an interesting point. But we have to understand one thing, that investing is a game of probability, right? And this is not a binary kind of a factor over here. This is not a factor where we are saying it's a red flag. It's not like a blacklisting parameter, right? So suppose this is a very good company, but they don't have a big four, right? So yes, what is the score that we have for say auditors? The total scoring is only 5% out of the 100. So even if they don't have the big four, and if they have a null auditor, we'll give them 2.5. All that they will lose is 2.5, right? But for them to be in the AAA category, they just need 85% plus. That's why we have these ranges, 85 to 100, 70 to 85. So even if on one or two parameters, for whatever subjective reasons, one may have an argument, but you have enough space to score on the other parameters, right? So even if you lose 2.5% marks on an auditor, I'm sure out of 97.5, if you are able to score 85 plus, you will still be in the three, in the AAA category, right? But we will have to draw a line somewhere, because whether we like it or not, yes, there have been mistakes by the big fours in the past. A classic example is Satyam. This is a more than a 20-year-old problem, but that is, that was a very serious challenge. Where Satyam showed cash on the balance sheet and there was no cash. I mean, there was no bank balance in the bank, right? So there was a serious amount of fudging out done there, and auditors missed it. For whatever reasons, today the kind of the regulations that even the auditors have to face, the kind of the stakes that the big four have today, not only in India but globally, I think they are far more stringent. You talk to some of the companies which have some of these big four auditors versus the other auditors, and they say that as soon as the big four came, they have tightened a lot of our processes. They have tightened a lot of their auditing. So big four definitely get onto the table with much more stringent processes. So they deserve to have higher scoring, but it is not part of our make or break kind of parameters. Like for example, when I said promoter holding pledge more than 70%, once it is above 70%, it's a make or break. Once it is above 70%, we will not invest in those companies. Whereas if an auditor is an unknown auditor, it's not that it will not be a part of our investment universe. The company will very much continue to be a part of our investment universe unless the overall score goes below 50%. So only auditor will not take the score below 50%. So we have to keep that in mind, that investing is a game of probability, and we have to create the module in that context.
Understood. Another question that has come up says that, is equal applicable only for your PMSs or also the AIFs that you do currently, which is the Cat 3 AIFs which we have?
Well, E-QUAL is applicable to all the investments done at MK Investment Managers, whether it is a PMS, whether it is AIF, whether it is an advisory. So for our entire investment universe, or for all the investments that we do at MK Investment Managers, E-QUAL is the first barrier that we have to pass through.
Sachin, one question which has come for our flagship PMS, the Capital Builder, is a question on liquidity. Now, suppose we have to liquidate the Capital Builder portfolio completely. How much time would it take for our entire portfolio to be liquidated?
I would like to share the portfolio on the screen, and you will get a sense that it will not even take more than half a day. Probably it will take less than 1 hour to liquidate the entire portfolio. Forget so many days, because we have it's a fairly large cap bias portfolio. In fact, the average market cap of the MK Capital Builder is probably right now 2,75,000 crore plus. That itself tells you the kind of the liquidity that we have in this portfolio. Ganesh, would you like to share the portfolio? MK Capital Builder, the slide that we had in the screen. Yeah, slide number 13 or 14. 12, slide number 12. Nagesh, is the portfolio visible?
Yeah. Make it full screen.
Yeah. Is it better?
It's still not full screen, but yeah, we can go ahead.
Okay. So, you can see some of the names out there. I mean, there's a lot of them are actually nifty names, whether it is ICICI, DVs, HDFC, Sun Pharma, HCL Tech, Bharti Airtel, Infosys, iShares. In fact, Zomato is now almost a 2 lakh crore market cap. Axis Bank, Maruti, these are all recent additions also. We also have a decent share of mid and small caps, particularly small caps, the NIITs and the Federal Bank. But these are extremely, extremely liquid counters. My sense is it will not even take us more than a couple of hours to liquidate the entire portfolio. You can stop.
I think, Sachin, you're making a very interesting point that it won't take even half a day where, there has been so many stress tests which has been going across in mutual funds, and it's giving so much stress to the customers also currently. I think that's a fantastic point that you have made, considering Capital Builder as a PMS portfolio. Okay, the question is it similar for our mid and small cap strategies also? But this question specifically asks about small cap strategies. Is the scenario similar? Does it still take half a day for our mid and small cap portfolio also to be liquidated? Sachin, you're on mute.
Yeah, Nagesh, I would believe so, because one of the very other important parameters that generally we focus when it comes to liquidity, if you see our E-QUAL model, I will again show you there. Generally, Ganesh, we can go to the E-QUAL model liquidity. So again, one other interesting parameter that we focus also is that generally we would not like to have more than 1-2% of the free float, right, of any company that we would like to invest in. And that gives us the confidence that investing and liquidating all our positions in a particular stock will not be will not be very difficult for us. Also, Nagesh, another experience of last so many years that I had, some of the companies which are mid and small, whenever one is looking at, they may see very low volumes, not too much of volumes happening. But what we have also observed is that for good quality companies, whenever there is a seller, there are always buyers. And sometimes the volume is not there because the buyers are not there, but because there are very less sellers. So if we want to actually sell some of these good quality companies, buyers tend to emerge, and there are always buyers waiting out there to lap up to some of the large quantities of good quality companies. And that is what really helps us when we want to liquidate our portfolios. So, investing, as we always internally discuss with our team, investing is actually a lot to do with at the time of entry rather than exit. If you have done the entry right in terms of selection of your stocks, into the right purchase price, in terms of having the right allocation in the portfolio, not going overboard with some of these companies, I think exits are fairly smooth. And the proof of the pudding is that our MK Emerging Stars Fund Series 1, 2, 3, and 4, which were all four were small cap focused funds, and we were able to exit more than 700 crore worth of stocks in a very, very smooth fashion with hardly any impact cost. We returned money to investors much before time, almost 3 to 6 months in advance. So we have gone through this over the last 11, 12 years, and that also gives us a lot of confidence.
But Sachin, does this hold even if the size grows, say, multifolds in our mid cap and small cap PMS to say 2,000, 3,000 crores? Is still this applicable, or that parameter remains similar across? Because we spoke about 700 crores, but what about if that size was, say, 6,000, 7,000 crores?
That's a good point, Nagesh. But the other good thing, the fortunate thing for us is that today the size of the market is expanded.
That's
For
right.
example, about 5 years back, the small cap company, the smallest small cap company, the market cap was only 15,000 crores. If you would ask anybody today to guess what is the what is the largest small cap company, the market cap is today 25,000 crore. So unless you are a market cap about 25,000 crore, you are considered a small cap company, right? If you are a 40,000 crore market cap company, you are a mid cap company. What I'm trying to tell you is that the kind of the size of the companies have also grown, their profits have grown, their market caps have grown. So even if I'm building a small cap portfolio, I will have a lot of companies which are at the market cap of 15, 20, 30,000 crore. And for me to liquidate over there shouldn't be a problem.
Got it. But a little bit irrelevant question, but why is there so much stress with the mutual funds, small cap and mid cap, then in the small cap space? Uh,
No, I think again there, Nagesh, the sizes are very different. Some of the small cap mutual funds have grown as large as 40, 50,000 crores now, 30,000, 40,000, 50,000 crores, right? So they will definitely need a little longer period of time. They also have some 60, 70, 80 stocks, right? Whereas our portfolios are extremely, extremely focused portfolios. We just have about 20 odd stocks. 18 to 22 is our sweet spot. Even for a small cap portfolio, we generally don't cross beyond 25 stocks. That is our hard stop, right? So we are much more focused, we have much more sharpness, which gives us far more agility, to exit, entry, and a lot of those things.
sure. Friends, if you have any further question, please type. I think, Sachin, there are no further questions which are coming in. I think it's time that we wind up this session. Friends, thank you very much for your participation. This was first of the kind of session that we did right now. We plan to do this on a regular interval going forward. Thank you very much for joining in. Thank you, Sachin, for your inputs on the E-QUAL advantage that you have provided. Participants, we will share the link for you where you can watch these videos. If there are any further questions, feel free to write into us. We'll be more than happy to answer those questions. Thank you very much for your time.
Thank you,
Pleasure.
everyone. Thanks a lot. Have a nice evening. Thank you very much.